To some people, that sounds like crazy. Why would I borrow my own money? Like that doesn't make add interest. Why would I borrow and pay interest on my own money? But don't forget, you're borrowing against the plan that's paying you interest. So you're paying interest on the loan. It's paying you interest back. It's not always a wash, but they kind of move together.
Be the change you want to see. Make a difference by giving your money a purpose, a mission to do good. Welcome to Money with Mission, where we show you how to create passive income so that you have options for how to work and how to live your life while leaving a legacy of positive social impact.
Welcome back to Money with Mission. Today I have Tom Wall. Tom is going to talk to us about retirement. And one of my first questions to Tom is going to be, what does that mean? And then we'll kind of get into the things that Tom teaches, Tom's relatively new book. And I'm pretty excited because I think I have a lot of questions on my own for Tom. Welcome to the show, Tom. I appreciate it.
Thanks for having me, Felicia. Great to be here with you.
Yeah. Hey, I know you wrote a book recently. Probably you didn't write it recently, but it's been out there on the market. It takes a while for us to get these books written. How did you get from day one of Tom Wall's life to where you are today? And the few of the highlights of going from were you born understanding money and how money works, or how did that come around to you?
It's a great question. No, not at all. My journey with money really probably started 20 years ago when I entered the business as a new financial advisor, really a life insurance agent at the time. And how I came to be the person I am today is I learned early on in the business that people are just afraid. Their fear drives so much of what people do or don't do. Mm-hmm. And when I became fascinated with, it was probably my third year in my career. My mother passed away from lung cancer. And all her life, my father was traveling and working hard, and they didn't have a whole lot. We grew up okay, but didn't have a whole lot. But then he finally started to do it, and he started to finally make the money and be able to travel the world. And then in her mid-50s, all of a sudden got robbed of that opportunity to go see it. And I've seen it over and over the years where people, they save so much to get to that promised land, that retirement date. And then that date never comes, or that date comes and they only have a few years. And there's this struggle that I see in the financial planning space where people are underspending because they're just afraid of all the what ifs. So my approach, and the reason I wrote the book, was to kind of help people get a little freedom around making sure that the things they care about are in place, so that they have those safety nets in place so that they can feel comfortable spending and enjoying that which they've spent a lifetime accumulating.
It's really, really good. So it was with your mother and father having saved to have the life they wanted once they stopped working, and then that basically being taken away, that it just kind of got you in this place of, wow, we've got to do something, got to figure out a different way to manage this so that you can live a life you want to live while you're living.
Yeah, it's the puzzle of financial planning, in my opinion. I think saving and investing is not hard. You can read any number of books about how to do that. It's really about beginning with the end in mind and having a plan to spend, a plan. What are you actually going to do with it once you get there?
Beginning with the end in mind, bringing that back around. Retirement. You know what? I grew up understanding retirement is you go to work, you work for 20, 30, 40, however many years, you retire at the time. I think the age to retire was 65. I don't even remember, but what's your definition of retirement? Something I've been struggling with a little bit.
For me, I think my definition of retirement is working on my terms. If you think about the traditional definition, 20 years ago, you couldn't get on a Zoom with somebody like that. That wasn't a possibility. You were showing up to work. So naturally, everybody wanted to have a day where they didn't have to go in anymore. Mm-hmm. Still true virtually. You want to be able to not do that, but I think it's a matter of defining that. So retirement doesn't ever have to be the traditional retirement. I'm not sure that retirement is really the right word anymore. There's people that call it financial independence, where it's more about choosing how you spend your day versus having to work or not having to work, kind of a conversation.
Yeah.
I can tell you personally, that's how I envision my life unfolding, is, changing and adjusting, but I can't imagine a day where I just snap my fingers and now I'm done.
Yeah. So what I'm hearing you say is the traditional retirement is you stop working and then you fish, or you just travel all the time, and you don't ever do any, I'm going to use a word, productive thing. And by productive, I mean something that makes money for the rest of your life. And what I like about what you said is it's working on my terms. It's doing what I want to do when I want to do it. And that may be productive for me as far as financially productive for me, or it might just be health and wealth protected for me. So that I like that definition, doing what I want to do on my terms. Really good. We'll talk about permission to spend. All we learn about is accumulating money, right? Let's get this big old pool of money at the end of so that at the end of our time, we'll have this. And then nobody ever talks about, what am I going to do with it? Or what do I do along the way with it? How do I make it the best it can be? Help us with that. You spent some time with that one.
Yeah. So I got my doctorate in retirement income planning. And one of the core pieces of
Time out. Doctorate in retirement income planning. Did anyone else out there not know that was a thing? That's amazing. Retirement income planning, PhD. Listen to Tom, you guys. That's some work. Okay. Sorry to interrupt you. Go ahead.
Not at all. I got it because I got fascinated in some of the original research that was really done 30 years ago. So many people have probably heard of the 4% rule. Everybody in financial planning knows what that is. But basically what it says is, if you look over the last 100 years and you started taking distributions out of a portfolio that's moving up and down, in the worst case scenario, the worst year, 1966, you could have taken only 4% and then had that money last 30 years to start. So starting with $1 million, you could only take $40,000 if you wanted it to last the next 30 years after 1966. So there's something called the 4% rule, which basically said worst case scenario of the last 100 years, that's what you could have spent. So if you think about it as a retiree, you save, you accumulate whatever you can accumulate, and you say to your financial advisor at retirement, how much can I spend and know that it's going to last at least 30 years? That's the safe withdrawal rate, if you will.
4% total accumulated portfolio.
Yep.
Okay.
And that's probably lofty, honestly, based on some of the things that are happening right now in the economy. But what's really fascinating to me is just 15 years later, had someone retired in the early 1980s, they could have spent 3 times that amount with the same level of safety. So who are you going to be? And this is the puzzle I think that a lot of people don't realize is out there is, saving and investing really isn't all that hard. I mean, you can just put the inputs in, put the money in there and be somewhat responsible about it. There's a lot of tips and tricks to get you wealthy. But when you start spending money, a lot of those rules that were in place that helped you generate that wealth safely actually work against you when the money's coming out. So, where I got fascinated was there was this really understudied part of the market, which is using annuities and life insurance, not sexy stuff, but annuities and life insurance as ways to kind of guarantee legacy to the next generation, guarantee, pools of funds that are not subject to market exposure, have insurance benefits, pooling that risk. So you can essentially offload your risk so that you don't have to cling to your cash just in case bad things happen. You can actually spend it and enjoy it because those risks are off the table. And that's what I've dedicated my career to, really.
So, okay, I'm going to back up. You said in 1966, taking 4% would have gotten you whatever, and you would have barely been able to make it however long. I can't remember exactly what you said, but what more interested in 1980, you could have spent 3 times that much and done fine. What happened in 1980 that made it that much better? And so let me stop there.
Well, interest rates spiked in 1981, which created a really good environment for bonds. Bonds were really good. So most people own stocks and bonds in their retirement accounts. So the 80s and 90s was tremendous for the stock market. At the same time, it was tremendous for the bond market. And just the economics of the time were great. Inflation was low. Just everything was great. So the puzzle is we just don't know who we're going to be. We have no idea what the next 30 years looks like. So people have no choice but to underspend if they don't have other insurances and stuff in place.
Okay. So that's a predictability thing. And we can't necessarily predict what the bonds are going to look like and the stock market's going to look like. Okay. Got it. And then, an annuity, define annuity for me.
So an annuity in its simplest form is the opposite of life insurance. So with life insurance, you pay a little bit of money every year. And if you die, you get a big lump sum for your family. With an annuity, it's the opposite. You give a big lump sum to an insurance company, and then they will pay you every year for as long as you live. Even if that's 80 more years, they'll continue to write those checks to you, just like a pension. So it's a way to basically turn your savings into a pension.
So a life insurance, you said a big hunk of money to a life insurance company compared to, that's the annuity. The life insurance is you pay a little bit to get a big hunk at the end. Yes?
Correct.
So an annuity, say you pay some amount in, big amount, 100,000, pick a number. into this annuity? You pay that once or you pay that every year?
Well, there's various kinds. There's literally hundreds of different kinds of annuities that you can have set up. In its simplest form, you just give a large lump sum, and then it would be paid out over time. But you can accumulate that over time. You could contribute to it.
Got it. You're educating me here and I appreciate it. The $100K you put in tomorrow for your annuity, and that's whatever I guess there's rules around different annuities on what you can do, right? Is that the,
Yeah,
okay.
but yeah,
Okay.
it's true.
And
That's how it works.
I'm thinking about doing an annuity and I want to start getting paid in 5 years. Is that unusual? Is that not practical?
No, you can absolutely. It's called a deferred income annuity. So you could trade that lump sum of cash for monthly income that starts immediately, or you could have it start 5 years down the road. There's even extreme examples where payouts don't even start till you're 85, almost as like longevity insurance, just in case you live a very long time.
Gotcha.
Your money.
Okay. Okay. Help me understand taking a lump sum of money that I have and putting into something that's going to then pay me out over time. What's happening to the money with the company I just invested into? Where did my money go?
That's their money. So they basically they collected your money, and in return, they will make a guarantee that you get paid as long as you live. If you were to die in a couple of years, you'd essentially lose the bet, if you think of it that way.
Okay.
If you live 40 years, you'd win that bet very handsomely as those checks continue to roll in. So it's insurance. It's essentially, we don't know how long we're going to live. That's a way where we can essentially, I've heard the term pensionize our savings. Whatever you're able to save, that's a way you can lock it in and guarantee that that's going to pay your monthly bills for as long as you're around. So it's an important piece of the retirement income.
Okay. When you're looking at someone's overall retirement, or I want to be able to do whatever I want to do when I want to do it plan, they come talk to you, and do you help them set this whole plan up and look through the whole situation? So say I'm 40 years old and I want to be able to do whatever I want to do in 10 years. And then you work through and see what I can do, or be able to do to help me be able to work through that so that I can then be getting paid and maintain the lifestyle I want to maintain.
Yeah. So typically the way it works, every case is so different. Everyone's assets and backgrounds, inheritances, and their job, it's all so different. But yeah, generally speaking, you're going to look at, what you need as a number in retirement. And a lot of people get into the mindset of either or. What is the best thing to do with my money? And if there's an answer to that, it would be doing it.
Yeah.
Really what makes more sense for most people, they call it income flooring, where, you need a certain amount of money per month, whatever that number is. Some of it's discretionary, which is just fun stuff. And some of it's non-discretionary, which is like, clothing, housing, transportation, things that just have to get paid for. And usually that stuff that has to get paid for, those monthly expenses that never really change, that's usually what we use annuity income for, or pension income, or even Social Security. That will kind of create the floor. We know the checks are coming in every month to pay for that. And then we'll get creative with the investments to do the more discretionary stuff, which is vacations and the nicer cars or the golf course, or is for you.
Yeah, this is really interesting to me. That's really, really cool concepts. So talk about leading me from where we're talking now to now I have permission to spend. Just really be direct with that. I think I get the connection, but I need it more concrete, black and white.
So if you think of your investment portfolio let's say we do have the traditional retirement definition where you turn 65 or whatever and you flip that switch, right? And the assets that you have, well, you can have them invested, and that account balance is going to go up and down every day, and you're going to spend with whatever risk tolerance that you have, 4, 5, 6% of that per year, whatever that number is.
I'm sorry. Let's back up and say we have it invested in the stock market. Is that what you're talking about?
Yes. Yeah. Invested in the markets. Right.
Okay. Go ahead. Sorry.
Yep. So that's one. Alternatively, you could trade all that money in for an annuity, which would be the same thing. You'd get income, but it would be guaranteed for as long as you live. There's a reason in both of those scenarios. There's typically I call them the 3 L's that people are really, really concerned about, that hold them back from either trading that money in for that stream of income, or spending significant amounts of money, like above that 4% rule or whatever you look at. And that's one is legacy. All right. Oftentimes people have children or loved ones. I call it the children, church, and charity. The people that things that they want to leave money to.
Mm-hmm.
Sometimes with an obligation to a spouse, it doesn't have to be anything bigger than that.
Right.
So there's a legacy piece. There's also the liquidity piece. So if you trade in your money for an annuity, you don't have access to that capital anymore. You gave it away in exchange for an income stream. And really, if you think about it, even if you have a big investment portfolio, you don't really have access to that money, because if you start invading the principal, that's going to impact how much income you get down the road. You can't be irresponsible that way. So people having access to a significant source of cash that's not going to impact their income is important too. And there's a really big one, which I think your market will appreciate, which is long-term care. The potential for ongoing medical care, which is very expensive and often not covered by traditional medical plans, that can wipe families out, or at the very least, put a huge strain on the income. So if there was a plan in place which could provide liquidity, access to capital, it's not going to impact your income, which would guarantee a legacy to some degree to your kids, your children, church, and charity, and would also give you, some protections against the potential for expensive ongoing medical care that's not typically covered, that would give you permission to increase your lifestyle a little bit and not essentially act as your own insurance company, protecting yourself from what could possibly go wrong. When in reality, for most people, things go right for a long time.
Mm-hmm. Yeah. Okay. I think I might still be a little bit confused. Okay.
I own that.
I have a 401k. I have it, let's say, because most folks know 401k, IRA, that's their hunk. And right now they know that when I retire at, let's say, I think it's 59 and a half, I can start withdrawing from that without penalty. Let's make this as my concrete brain. Okay.
Yeah.
And is that the one you're saying that the 4% rule, you can withdraw 4% of that every year, and to make sure you have enough to last? Is that the 4% money?
Historically speaking, 4% is always for it. Yeah.
Gotcha. Generally. So, okay. So 4%, that's, I get it now. Okay. So I don't know if I got to do that, then I can't really live necessarily the way I want to live, because I got to make sure that lasts. Yeah. In addition to that, you're saying as another stream of income is this annuity that you put money into. And I'm assuming you decide how much money you want to be getting every month for the rest of your life. And that's how determines how much you need to put into the annuity. Yes.
Yeah. And I think the missing piece there is you can trade your 401k in for an annuity. You can turn your 401k you can take that investment account and buy an annuity with it. So that's an option. So instead of being afraid and only spending 4%, you can trade it in and maybe spend 6 or 7, because that's the cash flow that annuity would kick off for as long as you.
Okay.
But to do that.
Okay. So if that's like trading your 401k over here, that's not going to incur taxes and penalties because you did that, correct? It's like you still have your retirement account.
Yeah. It's like turning your 401k into a pension that pays out every.
You do that before you turn 59 and a half, I think is the year, or do you have to wait until you turn 59 and a half?
There's in some cases, I would say no. For broader audiences, I would say no, but there are some cases, yes, you can.
Okay. With money that I've invested into an annuity, and say I think one of the companies I read, I believe, is Northwestern Mutual, Mass Mutual. Those are the companies that have annuities. There's probably a ton more. Those are just the ones I knew. So those are also insurance companies. So there's life insurance and annuity situation here. What are they doing? How are they making sure that they have money to pay me every month?
Oh, there's some strict rules around that. So, those insurance benefits, whether it's an annuity stream or death benefits via life insurance, they are, statutorily required to hold a certain amount in reserves. These institutions, the ones that you mentioned, some of the biggest, oldest institutions, they date back to the mid 1800s, and they're very highly rated, usually more highly rated by the financial rating agencies than any other institution, because statutorily they're required to hold hundreds of billions of dollars in reserves to make sure that those claims that they've guaranteed are funded. So what they do is they just invest conservatively. They have a big old portfolio of bonds and real estate and subsidiary companies, but they are required to have essentially the present value of all those future benefits in investments.
Okay, compared to banks that we all know there's a whole banking situation right now. Banks are going down and all that kind of stuff. So your money is more safe there than in a bank. Yes. As far as what that company has, what their obligation is to hold their money, or how they have to back their assets. Let's put it that way.
I would say that, yeah. I mean, there's no FDIC insurance. I mean, that's a complicated discussion, but yeah,
I got you.
different.
And I was going next is that your money is invested, although you say use the word conservatively so that there's more likely to be a return, but there's always the possibility that it's not a completely 100% risk-free thing to do, correct? Whether it's life insurance or annuity.
No, there's always risk involved, but these tend to be the very conservative part of the portfolio.
Gotcha. Yes, I understand. Yeah, I understand that. They're the most safe things to do, but I don't want people to think that anything is without risk at all. You do
No.
look at your risk tolerance. You look at the risk. It's like doing a surgery. You look at which one is going to be the most safe for this person and also going to accomplish the thing you want to accomplish, but there's nothing that's risk-free. That's where I was going with it. Okay.
Yeah.
All right.
And I think to add to that, what I would say is, when you look at investing or just money management in general, there's a lot of higher risk things that are beneficial, like investing in stocks, investing in real estate, investing in your own business. These are the things that generate real wealth, that people, it changes, generations. But generally speaking, a prudent plan has a bunch of safe stuff in there, boring assets that are guaranteed to go up, they're accessible. And I jokingly say that, dividend pay whole life insurance is probably the best boring money you can buy. Like where you just, what you're getting, there's guarantees, there's enhancements to those guarantees that provides that legacy. And that's the backbone of your plan. So you can then shoot for the stars and really accumulate real wealth, generational wealth in those more traditional ways.
I'm going to say, guys, I do have a whole life plan, and yes, it is boring, but the money's there. You can look in there and there's money there. And do I 100% understand it? No, that's why I'm drilling Tom right here, trying to understand it. But it's not exciting. It's not sexy. It's just like putting your money in the bank, only to me a little bit safer. Actually, probably a lot safer. But anyway, that's a whole nother conversation. Tom's trying not to go there.
Happy to go anywhere you want.
I appreciate it. I appreciate it very much. Okay. What have I not asked you that people need to know about managing their money whenever they decide to, air quotes, retire?
A great question. I think we actually did cover it for the most part. The first words in my book are, you will be afraid to spend.
Mm-hmm.
And that's what people understand. When you get to retirement, whatever that looks like for you, I mean, unless you're fabulously wealthy, you are going to look at whatever you accumulated and say, man, I'm afraid. What if I live 50 years? What if the Great Depression is again next year? What if there's massive market crashes? What if I require millions of dollars of care that isn't covered by insurance? Or you're going to be terrified no matter how wealthy you are. So I think real planning doesn't stop at 65. I think the traditional financial planner really is just pulls out a fancy calculator and does backwards math to tell you what you need to do to get to your number, whatever that is for you at retirement. The real forward thinking, the more modern planner is going to talk to you about how do we spend that money down in retirement, tax efficiently fund your goals for your children, for whatever kind of charitable interest that you might have. And how do we maximize the dollars that come out? And not later in life. It's been shown over and over again. We all kind of know this anecdotally, but the data shows people spend way more heavily in their 60s and maybe 70s than they do in their 80s and 90s for all the reasons we understand. And that's the puzzle. That's the retirement income puzzle, is how do we push as much of that wealth to the front years when we're most healthy and able to enjoy all that wealth by traveling the world and doing all those things. Because otherwise you just kind of live scared. And then when bad things don't happen, you give yourself a pay raise at advanced ages when you don't want to spend it anyway, or you're not capable of spending it. You might not even be alive, And that's the tragic part about my industry, I think, is a lot of advisors don't get that.
I was thinking about a couple of things. The spending more in your 60s, 70s, even maybe into your 80s for the stuff you want, but does it balance out if you need long-term care? Because that's pretty expensive too in the end. Your last few days, just medically speaking, we know there's a high rate of spending in the last part of life that these things could help cover. Very interesting. This is really interesting.
Well, that's a big part of the planning is, you buy insurance against insurance exists for a reason. It's why car insurance costs you almost nothing. And you think about how much you could owe for something. It's pooling of risk. So with life insurance, with long-term care insurance, some of these are now merged into hybrid policies. You can own them together. It pools that risk, but it doesn't. If you do it right, you can do it in a way where even if bad things don't happen, you still profit. You still benefit from it. Your family still receives tax-free wealth from these plans. And that's the big, unlock, if you will, is shifting those risks so that you're not afraid while you're alive.
Another question came to mind about borrowing against your whole life policy. How does that affect anything, if anything? And can you borrow from your whole life policy to buy an annuity? Does that make sense? These are getting pretty weedy questions. So
absolutely can. So, the reason whole life insurance is so great, and this is why I spend so much time talking about it, is it really does two things very well. One is it manages risk. All right, the insurance company guarantees you that it's going to go up in value, and then they enhance that value with their earnings, how they're doing. When you see not always, but when you see one of these big insurance companies called Mutual, you said Northwestern Mutual, Mass Mutual, that means they're essentially operating for their policy owners. There's not shareholders that are taking profits. So when the company does well, you as one of the policy owners do well with it. That's what the dividend is. So there's the risk component, but the other piece is taxes. So what you just mentioned was a policy loan. You can typically get your money back income tax free. So if you put in $100,000 to a whole life plan, you can typically get back $100,000 tax free. But policy loans allow you to essentially get an unlimited amount back tax free because it's a loan. It's very unique to life insurance. So some people that sounds like crazy. Why would I borrow my own money? Like that doesn't add interest. Why would I borrow and pay interest on my own money? But don't forget, you're borrowing against the plan that's paying you interest. So you're paying interest on the loan. It's paying you interest back. It's not always a wash, but they kind of move together. So where it fits really well is, I'll give you a great example. My own father called me. It was 6 or 8 months ago. It may have even been last year. He called me. We were talking about something else. He said, "Hey, that policy that I bought like 15 years ago that you were talking about? You fought with me to buy, and you said you had to do this, and I fought you for years and never did, and I finally did it. Well, now it's got a lot of cash in it. And I just called up the company and took a huge loan against it. My father's done pretty well. He has money. I'm like, Dad, you have other money. Like you've done well. Why are you taking loans against life insurance?" And he basically said, "Well, I looked at my old portfolio, and everything is down. My stocks are down, my bonds are down, and I don't want to sell them low. I don't want to lock in my losses. I just wanted to kind of let them recover." Yeah. And that's where it fits. So I think in retirement, it becomes a strategic asset. And actually my book talks a lot about how it works as a strategic asset, not necessarily better than others. Otherwise, if you don't have that, stocks are down and that's where your money is. You're going to have to sell at a loss to get your money out.
Mm-hmm.
It's kind of why people with those 3% mortgages are hanging on to their houses right now. They might want to move, but they're not going to.
I'm not giving this up. Tom, this was amazing. Where can people find your book, number one?
Books on Amazon in all formats. So you can find me there.
And it's called Permission to Spend, Tom Wall, PhD. Tell me one more time what your doctorate's in income retirement?
Retirement income planning. It's pretty unique.
Planning. It is pretty unique. PhD in retirement income planning, Permission to Spend. You can go to Tom's website. That'll get you there. You can go straight to Amazon to get you there. How do people get to you if they want to talk to you and learn more about the way you help get this whole foundation of money together?
I am at tomwalltalks.com. You can find me there. That'll links to social media. Tom at tomwalltalks.com is my email address. Okay. By all means, reach out. We'd be happy to help you and connect you with some of the best in the business.
Awesome. Anybody, you guys, I know you're out doing 5 things at once and you just heard that and want to have it down, go to the show notes. It'll be there. How to get in touch with Tom. You guys, money is something that we don't talk about enough, and we need to because we all need it. This is how we function in our society today. So make sure you know the words around money, educate yourself about money. Financial literacy is education and not something we're taught about on a regular basis. This was an amazing conversation. I learned a lot. There's words there that Tom helped me to understand better. I'm going to read the book. I started it, Tom. I promise I started it. I just haven't gotten through. Thank you so much. I appreciate it so much.
Thanks for having me on.
All right.
Take
See you
care.
guys.
You've been listening to Money with Mission. There are projects happening right now where you can have a great financial return while positively affecting the lives of others. To learn more about our opportunities, go to moneywithmission.com.